we're near record highs in the amount of silver bars that are just stuck in the vaults in New York. You mentioned that the big refiners are not hedging.
Also, LBMA COMEX rated too. They stopped buying scrap for a little bit because they were overwhelmed with it. That's gold, not even silver. When they came back and said we're buying gold again, they came out and said that we're no longer hedging right now.
This is all not instability in gold and silver, but it's instability in the dollar. That's what's going on. It's reflected in gold and silver now because right now the main money is the dollar and gold and silver are the products, but in reality it's the other way around. That seems inconsistent to me, unless there's demand for COMEX bars, but they're not going to be sold because if open interest is low, that means the amount of bars that are for sale are very low and the rest are just being hoarded in the New York vaults. That doesn't make sense, but why would you need specifically a COMEX bar? You want to sell the 1,000-ounce bar on a registered futures market or something, but you're not going to do that now, so you're just going to keep it in storage. There's a lot of wholesale speculation that is not being put for sale, just like you were sitting on a year and a half of inventory. I take a survey of what people are saying generally, and I hear a lot that, oh, the COMEX is being drained. I hear that all over and over again. But then I look at the COMEX and I see that, it's gone down since 3 or 4 months ago, but still, aside from that, we're near record highs in the amount of silver bars that are just stuck in the vaults in New York. So somebody owns these things. And the other thing I wanted to ask you, maybe you know this, that I've been tracking the open interest in silver futures for a while, and I've noticed that it's extremely low right now. I mean, there was a little bit of a bump up yesterday, about 4,500 contracts were added, but we've been below 100,000 for about 2-3 weeks now, and we haven't been there since like 2008, 2009. So, and you mentioned that the big refiners are not hedging. First of all, why are they not hedging? And do you think that this is related to the fact that open interest on COMEX is so low?
I don't know. That's kind of out of my wheelhouse. That's something that you could probably explain better. As far as the hedging goes, though, I know that, for example, these companies that were buying, like metal ore, for example, you're buying an ounce of gold. They were buying an ounce of gold for $1,200, $2,000, $3,000.
COMEX inventories are still near historic highs, yet open interest just collapsed to levels last seen during the 2008 financial panic. According to Rafi Farber, the disconnect matters more than the headlines screaming silver shortage. If refiners suddenly refuse to hedge while vault inventories remain elevated, then the issue may not be supply at all. It may be counterparty confidence quietly evaporating behind the scenes. That hits ordinary savers first through spreads, liquidity shocks, and pricing distortions they never see coming. Next, Rafi Farber exposes why massive silver stockpiles and collapsing futures participation can exist simultaneously without contradicting each other.
Now, that same ounce of gold is double and triple what they once paid, so it requires a lot more money and a lot more loans from banks in order for these companies to operate. Hedging, I don't know what happened with hedging. I've never really hedged, to be honest with you. I've always kind of just rolled the dice and let things fly upward. My feeling is that I just accumulate more silver and more silver and more silver, sell off excess when I can. And same thing with gold, but I don't really hedge personally. But I believe that hedging had cost them money somehow. And again, I can't explain that. I'll look more into it. But metal ore is again one of the larger gold companies or gold refiners out there. Also, LBMA COMEX rated too. They stopped buying scrap for a little bit because they were overwhelmed with it. That's gold, not even silver. Recently. And when they came back and said we're buying gold again, they came out and said that we're no longer hedging right now, and you can only sell your lot when it's completed. So, besides silver, no one really expected that with gold, and that really does put a big crimp on a lot of dealers out there on gold. You know what I mean? Because now you can't pay. If anybody's wondering why the percentages and the dealers have wider margins right now, well, there's your answer right there. Especially in gold. Well, why are the margins wider now? Well, because now your gold dealer doesn't have the ability to hedge with the major refiners.
Gold refiners quietly abandoning hedging while prices explode higher is not bullish optimism. It's balance sheet stress hiding beneath the surface. What Rafi Farber is highlighting here is that soaring gold prices now require dramatically larger credit lines, exposing refiners and dealers to financing risk most retail investors never consider. Wider dealer spreads are not random greed. They signal institutions protecting themselves from volatility and liquidity strain behind closed doors. When the largest refiners stop absorbing risk, smaller dealers and ordinary buyers become the shock absorbers instead. Next, Rafi Farber reveals why the gold market's hidden funding pressures are beginning to distort physical pricing itself.
But again, there are some companies out there, I think smaller companies that are locking in, possibly, I don't know. But my experience is just dealing with, again, Metalor, who's a great company, and knowing about Asai and their business. I'm still waiting to be approved by Asai, by the way, as one of their representatives and dealers.
Okay, so when you say that you never hedge, then when you sent out that tweet that you were stopping your purchases of silver from the public, since you don't hedge, then why did you stop then, and what changed that you started up again?
I had to assess the situation, what was going on. I had to sit back and, there comes, again, I just started accumulating so much inventory. And then some of it I was still able to lay off, like 90%. There were still guys making offers out there, but it was discounted very heavily. And I was selling, there's so much 90% out there. There was so much constitutional silver out there. The sterling silver scrap, where the margins are bigger for me and much better, I didn't mind accumulating sterling silver. Again, flatware, scrap, that kind of thing. But on 90%, I was selling it to other dealers that were heavily discounting it because, I could have easily spent everything I possibly owned in one day on 90%. You know what I mean? There's so much of it out there that
You mean so much people trying to sell you mean?
There's so much 90, yeah.
When physical silver floods dealers faster than they can move inventory, price alone stops reflecting real market stress. Rafi Farber notes that massive amounts of constitutional silver are hitting the market at steep discounts even while long-term bullish narratives dominate financial media. That contradiction matters because liquidity disappears first at the retail level before institutional cracks become obvious on Wall Street terminals. Savers holding physical metals need to understand that temporary dislocations can destroy confidence long before they destroy fundamentals. Next, Rafi Farber unravels why discounted silver inventory may actually signal refining bottlenecks rather than collapsing demand.
There's so much 90% out there that, if you came to me today and you said, listen, I want to spend $10 million and I want delivery in a couple days, it would probably be easy to do with 90% silver versus 999 silver or that kind of thing. It's just out there, you know what I mean? And the reason it's out there because nobody's refining it, nobody's really getting a chance to refine it and turn it into money.
We're not just doing this for money. We're doing it for a shitload of money.
So dealers are heavily discounting it, and that's kind of where we're at today. So I just, as soon as the dealers that I was selling 90 to said not buying, then I said I'm not buying. You know what I mean? So.
Okay. And now
it's all confusing. It's complex, and the way I do things may not always be correct, but. I just had to reassess things when I said I'm not buying right now because I didn't want to get loaded down with certain product. I had to sit and see where my situation, how much money do I have tied up, so.
Okay, but now things have calmed down and you're able to get the wheels going again then.
I got my first lot out, which I'm very thankful towards. I'm thankful towards the people at Metalor that helped me do that. And otherwise I'd still be sitting on it right now, So yeah.
Silver may be available everywhere, but the system processing that silver appears increasingly jammed behind the curtain. This is where Rafi Farber's thesis shifts from simple supply shortages to infrastructure paralysis inside the refining chain itself. Dealers refusing inventory despite abundant metal tells you the bottleneck is no longer mining output. It's capital, throughput, and risk tolerance. For ordinary investors, that means volatility can intensify even while physical silver technically remains available in the market. Next, Rafi Farber reveals why refining delays and liquidity stress could create violent pricing disconnects between paper silver and physical supply.
But again, I asked him, well, when can I send another lot? And there was really no answer. Will it be this summer? No answer. You know what I mean? So, so
Well,
I'm
you
in
hear
the
that,
same-
folks. If you want to make some money, then become a giant refiner somehow.
Yeah, well, I'm not quite sure why we didn't see more people step in there. But again, it still confounds me why there's only two CME. There's one COMEX rated and LBMA rated refiners in the whole country. So, there's only two. I don't know. I don't understand that. I don't understand why there's not more out there. But
Well, if you're a drug dealer, then the best thing to do is to take out your competition and make and like they did in Breaking Bad, right?
Yeah. Well, and again, this mining stuff, and I'm pretty certain I'm right on this. I have some evidence, but I don't want to discuss it, that I am right with the mining stuff coming through. At some point, I'm sure when that stuff starts to slow down, again, you're going to see more the domestic scrapper. The guys in the U.S. are going to be able to start buying again, and the spreads will get a lot tighter.
So as I was saying, that the open interest on the COMEX, meaning the amount of contracts that are notionally traded around, it's at lows not seen since 2009. At the same time, there's all this demand for COMEX bars.
The last time COMEX open interest collapsed this hard, while physical demand stayed elevated, was during the aftermath of the global banking crisis. According to Rafi Farber, the refining bottleneck and lack of new market entrants suggest institutional players may already see risks the public still dismisses. If only a handful of refiners control the pipeline while futures participation dries up, then the system becomes dangerously concentrated during periods of stress. That concentration risk does not hurt billion-dollar funds first. It hits smaller dealers, savers, and liquidity-dependent investors. Next, Rafi Farber exposes the contradiction between surging physical demand and vanishing futures market participation.
So that seems inconsistent to me, unless there's this demand for COMEX bars, but they're not going to be sold, because if open interest is low, that means the amount of bars that are for sale are very low, and the rest are just being hoarded in the New York vaults. That doesn't make sense. But why would you need specifically a COMEX bar? Because eventually you want to. I'm just going through the thoughts in my head, and whatever you think of them. But because maybe you're thinking eventually you want to sell the 1,000-ounce bar on a registered futures market or something, but you're not going to do that now, so you're just going to keep it in storage. I mean, it seems like there's a lot of wholesale speculation that is not being put for sale, just like you were sitting on a year and a half of inventory. It sounds like whoever's up there is sitting on, I don't know, 3-4 years of COMEX bar inventory that are just being stacked up there.
As far as the refiners go, I don't think anything stacks up the refiners. I think as soon as they process the stuff, it's out the door to whoever the bidder. Or
Yeah, it's in the New York vaults. You can see it.
Sitting at the New York vaults. But I mean, could it be COMEX that was buying all this silver? Could it be? It's tough to say. I really don't know. But
Even if
my
it's not
feeling
COMEX
was
itself. I'm saying it's
yeah.
someone who could potentially trade these bars on the exchange at some point.
Markets are supposedly liquid, yet billions in silver bars appear to be sitting untouched inside New York vaults, while futures activity dries up. As Rafi Farber points out here, low COMEX open interest alongside massive physical inventory suggests somebody is accumulating without any urgency to sell back into the market. That behavior looks less like speculation and more like strategic positioning ahead of systemic stress most retail investors are not prepared for. When physical holders stop caring about short-term price swings, paper pricing mechanisms become increasingly fragile. Next, Rafi Farber exposes why silent accumulation inside COMEX vaults may matter more than daily silver price action itself.
Yeah, well, they got to be going somewhere. And again, that's the mystery to me, because the refiners, as much as I like to talk to some of the people in that industry, in those two places, Asai and Metalor, they don't discuss anything about, who their customers are at all, pretty much. So, but I'd be curious to where all that stuff is going consistently, because again, it's not building up, and they're not saying, we're not buying it all, or we're not refining it all, So, on the other hand, too, those two companies can only produce so much. You know what I mean? And I think if there was a huge demand, a good point here. If there was a bigger demand, you'd see another refiner opening up. But I don't see that happening. You know what I mean?
Okay, well, I mean, it would take. I mean, there's other bigger problems in the world right now, like oil refineries are being bombed in the Middle East, and Hormuz is still blocked, and Trump seems to know exactly what he's doing because he's playing 17-dimensional chess or whatever people say. But I don't know.
I don't know, man. Why can't we all just get along? But anyways, yeah.
People have different ideologies.
Oh, I know.
Why. So this is all not instability in gold and silver, but it's instability in the dollar. That's what's going on. It's reflected in gold and silver now because right now the main money is the dollar and gold and silver are the products, but in reality it's the other way around.
Refiners refuse to reveal their customers, while geopolitical instability accelerates across energy markets and shipping lanes. Rafi Farber notes that if demand were truly exploding organically, new refining capacity should already be appearing to capture profits. Yet it isn't. That contradiction raises a harder question. Are institutions quietly securing metal for strategic reserves rather than speculative trading? Investors focused only on headline prices may miss the deeper signal that confidence in the dollar system itself is weakening beneath the surface. Next, Rafi Farber unravels why global instability is exposing the dollar as the real source of volatility, not gold or silver.
And that itself is being reflected in the in and out backwardation of silver that's preventing these companies from hedging. So again, all in all, what we're seeing, I think, is the flickering of the lights of the dollar system. And we're in those stages where, when you have a flickering candle, sometimes it flares up and gets really, really bright, and then it goes way, way down, and then it goes, in and out until it just goes out. So that move to 120 was, a big flare, and then now we're back in the dying phase, but it'll flare up again until the entire dollar burns out, and then we'll see what happens then.
Yeah, I mean, I think we've established some pretty, floors here. I mean, it sure seems like we've established floors with gold, what, 4,500 it feels like. Maybe, again, that's just my assumption. And then, silver seems like we've established a floor of, 65 to 70 or something like that, So, again, these moves are just crazy. First, oil's up, gold and silver and down, everything's down in the red. And it looked like this week it just completely disconnected from all that as well, So I have no clue. I got to listen to guys like you. I got to listen to you or other guys to figure out that end of it. So
I don't know. I'm guessing myself.
Yeah. My expertise is just in physical product, buying and selling physical product.
Silver backwardation keeps flashing on and off. At the same time, hedging activity breaks down across the refining sector. What Rafi Farber is highlighting here is that these violent swings resemble stress signals inside a monetary system losing stability, not a normal commodity cycle. Markets disconnecting from oil, equities, and traditional correlations is usually what happens late in major financial transitions when liquidity becomes unpredictable. For long-term savers, the danger is assuming volatility means weakness, when it may actually signal structural repricing underneath the surface. Next, Rafi Farber reveals the hidden timing pattern behind silver's extreme price spikes and sudden collapses.
Who I sell it to and what I can tell you from what they're doing and stuff like that. That's pretty much where I'm comfortable, All
right. Well, I think you're doing a good job, and
thank you.
And to survive in this environment as a small retailer. I think you really have to actually believe in your product because
Yeah.
otherwise it'll just, what other kind of dealer is willing to stack a year and a half worth of product and just have faith that you'll be able to sell it at some point. It's That's got to be very scary.
Um, Honestly, no. I mean, yeah, I think anything but silver. I mean, because I know, I mean, I know this is a crude way of doing this, but to me, this is silver. And if I could, and I'm in a segment of time like this, and all I need to do is just wait out this, just for a little bit. You know what I'm saying?
Yeah, I know, but that's
been
what I
my
mean.
philosophy.
You have to believe that
You
it's
believe,
money.
yeah,
Yeah, like
yeah.
if you understand that, it's just a different form of trading, except you're dealing with actual physical stuff rather than some number on your brokerage account and trying to,
Well, you said
out you.
confident in my product, and I'm 100% confident in my product. I mean, did I yell and scream when I kind of saw it go from 119 down to 70? Yeah, yeah. I mean, I did a little bit. I watched my net worth kind of drop quite a bit there, sitting on all that stuff.
Most investors claim they believe in gold and silver until volatility cuts their net worth in half overnight. According to Rafi Farber, surviving physical metals markets requires conviction that goes beyond paper profits and daily chart watching. The deeper story here is psychological. Institutions exploit panic cycles because retail investors rarely tolerate temporary drawdowns without abandoning long-term positioning at the worst possible moment. Physical holders, thinking in years instead of weeks, operate under a completely different framework than leveraged traders chasing momentum. Next, Rafi Farber exposes why emotional capitulation during sharp corrections often transfers wealth directly into stronger institutional hands.
However,
I didn't see it at all because it happened on a Friday, and I signed off because I'm on Israel time, and I don't go online on Friday night, Saturday. So the next thing I looked, it was Saturday night, and it had already gone down to, it was like 120 when I turned off the phone, and then it was like I turned on the phone, it was like 71, 72. I was like, what?
I know that's exactly, but I wasn't panicked about it. I wasn't upset. I just I was okay with it, kind of. I mean,
I
got
laughed. I giggled. I
Yeah.
was like, oh my God, okay, it's happening again.
A near 40% overnight collapse would normally trigger panic selling across most financial markets, yet some physical silver holders barely flinched. Rafi Farber's argument suggests repeated volatility shocks may actually condition long-term metal investors to think differently than traditional portfolio managers obsessed with quarterly performance. The mindset shift matters because systems under monetary stress often reward patience, while punishing leverage and emotional reaction. The real divide is no longer bulls versus bears. It's paper traders versus people preparing for systemic instability.